Hello everyone, this is Brandy Williams with an educational accounting and tax video. Please like, share, and subscribe to my YouTube channel. You may also follow me on Instagram, Facebook, and TikTok at Williams Act Tax. On LinkedIn, connect with me by searching Brandy C. Williams Mac. Lastly, visit my website, williamsacttax.com, to review my bio, read my blog, enroll in tax school, contact me, and schedule a free consultation. I look forward to hearing from you. Enjoy the video.
Income shifting. It is a known fact that the IRS has a zero-tolerance policy regarding tax evasion. However, tax minimization is well within one's legal rights. Since the overall tax burden could be substantial for most individuals and families, a number of tax minimization strategies are widely used to lower tax liability. Income shifting is among the most common tax planning techniques where taxpayers in higher brackets may transfer a portion of income to a lower bracket taxpayer. This is also referred to as income splitting. Various income shifting strategies are used in practice, and these are briefly discussed below. Hiring your minor child. Traditionally, parents would transfer income-yielding assets to their minor children's name to benefit from low tax brackets. However, the kiddie tax was introduced to counter this tax avoidance strategy. Now, any income earned by children from such assets, for example stocks, is taxed at their parents' highest tax slab, except for the first $2,300 in 2023. Now, a better alternative is to hire your minor child to work for you, at least on the papers. If you are a business owner and want to hire your child to work for your business, there are some tax rules you should be aware of. According to the IRS, payments for the services of a child under age 18 aren't subject to Social Security and Medicare taxes if the business is a sole proprietorship or a partnership in which each partner is a parent of the child. Payments to a child under age 21 aren't subject to TFUTA. Hiring your child can potentially lower your taxable income as you can deduct their salaries from your business income. If your child is under 18, and depending on the type of business you have, you won't have to take Social Security and Medicare taxes from their pay. Your child won't have to pay taxes if their income for the given year is less than the standard deduction for that year. It is important to note that if your business is a corporation, partnership, or estate, payments to your child are subject to income tax withholding, Social Security, Medicare, and FUTA taxes regardless of age. By increasing an employee to your business, you'd be decreasing taxable income of the business. Also, there are certain payroll tax benefits when paying a minor kid. The income earned by the child would be taxed at a much lower rate. However, make sure you can justify the arrangement. For example, you cannot justify hiring your 7-year-old kid as manager of operations. Moreover, this option isn't limited to minor kids only. You may hire other family members for the same purpose. The Uniform Transfers to Minors Act. While not applicable at the federal level, some states prohibit registering securities in the name of minor children. You can, however, transfer securities to a minor child under the Uniform Transfers to Minors Act, UTMA, or the Uniform Gifts to Minors Act, UGMA, rules or place the securities into a trust for them. It can be tricky, however. Remember that under a revocable grant or trust, the income would still be taxed to you. So, to take tax benefits, make sure that you are placing securities or other assets under an irrevocable trust. Delay bonuses and income. This strategy does not involve shifting income, but, in fact, delaying it. You can ask your employer to delay your bonus for a few months so that it falls within the next tax year. Similarly, you can employ various tactics to delay your income if you are self-employed, for example, by late invoicing or carrying a project for a few more months to receive final income at a later stage. This strategy is useful if you have had higher than normal income this year, but you expect to have lesser income in the next year. Benefits of a trust. While these benefits are briefly discussed earlier, make sure you understand the kind of trust you are putting your money in. What most parents do is to shift income or assets on a recurring basis to plan ahead for educational expenses, for example. However, for tax benefits, remember that you are essentially giving up your control on these assets or income. Family limited partnerships. There are several benefits and drawbacks of establishing a FLP. However, one of the most commonly cited benefits is that of reduced tax liability. What you are essentially doing is to divide total shares of your business among different family members. So each member is expected to pay their own tax on a portion of income received thereafter. So a considerable portion of your business income may ultimately be taxed at a lower rate.
This is Brandy Williams. I hope you enjoyed the video. Please like, share, and subscribe to the channel, and follow us on all social media platforms.